Good morning, students. So in this video, I'll explain financial statements, section 129 of Companies Act 2013. Okay, right. So first we'll see the financial statements is a set of documents. Financial statements is a set of documents. So financial statements, we'll say financial statements. It is a set of documents. It is a set of documents. Now we'll discuss what are contained in that set of documents. What are the inputs? What are the things contained in that set of financial statements? Now we'll discuss in this lecture. So the first one is balance sheet. First one is balance sheet. Everybody knows financial statements contain first thing is balance sheet. Second thing is profit and loss account. Second thing what is contained the financial statement is profit and loss account. Profit and loss account. Third thing is cash flow statement. Cash flow statement. And fourth thing is statement of changes in equity. Statement of equity. Statement of changes in equity. So these are the four components of the financial statements. So sometimes instead of balance sheet is mandatory for all. Sometimes instead of balance sheet, some people will prepare income and expenditure account also. Okay, in case of non-profit organizations, so rather than preparing profit and loss account, they may prepare income and expenditure account. Okay, so profit and loss account or income and expenditure account. Next, cash flow statement. So this cash flow statement is not mandatory. This cash flow statement is not mandatory for DOS. Remember, Department of Studies. DOS is what? Department of Studies. For short form, I have given DOS. Nothing but doormat company. Doormat company, one person company, and small company. Okay, for your understanding, I have given to memorize, I have given DOS, Department of Studies. Okay, doormat company, OPC, and small company. Okay, so shortcut remember DOS or Department of Studies, doormat companies, OPC, and small companies. So to those three entities, cash flow statement is not mandatory. Remember, one person company, small company, they have to prepare balance sheet and profit and loss account also. But for them cash flow statement is not required. And statement of changes in equity. Statement of changes in equity applicable only for companies following Ind AS. Applicable only for Ind AS companies which are following Indian accounting standards, not for other companies which are following Indian accounting standards. They have to prepare the statement of changes in equity also. Okay, so therefore, if I categorize the companies into various parts, look at this. Okay, if I categorize the companies into various parts, so companies following Ind AS, companies following Ind AS, next OPC, small company, doormat company, or our DOS, Department of Studies, doormat company, OPC, and small company, and other companies. Is I segregate the things, and then we'll prepare balance sheet, profit and loss account, cash flow statement, statement of changes in equity. Okay. Companies following Ind AS, they have to prepare all the four. Companies following Ind AS, they have to prepare all the four. Doormat company, one person company, and small company, they have to prepare balance sheet and profit and loss account. Cash flow statement is not required, and statement of changes in equity is also not required. Other companies, they have to prepare balance sheet, profit and loss account, and cash flow statement. Statement of changes in equity is not required. So this is what the point, which companies need to prepare which financial statements. Which companies need to prepare which financial statements. Okay, companies following Ind AS, they have to prepare all the four financial statements: balance sheet, profit and loss account, cash flow statement, and changes in equity. Doormat company, one person company, small company, they have to prepare only balance sheet and profit and loss account. For them, cash flow statement and statement of changes in equity is not required. Other companies, they have to prepare balance sheet, profit and loss account, and cash flow statement. For them, statement of changes in equity is not required. So these are the financial statements. Okay, four components of the financial statements. Next, essential characteristics of financial statements. What are the essential attributes of financial statements? Essential requirements of financial statements. Essential requirements of financial statements. There are three essential requirements. The first one is true and fair view. Ultimate object Ultimate outcome of any financial statements. Ultimate outcome of any financial statements is true and fair view. True and fair view is the ultimate outcome of any financial statements. They have to prepare true and fair view, and they need to follow accounting standards. And they need to follow accounting standards. And they need to follow accounting standards. And they have to prepare balance sheet in Schedule 3 format. And they have to prepare balance sheet in Schedule 3 format. Basically, these are the three requirements of financial statements. They have to show true and fair view. Remember, even though here or there you make mistakes in accounting standards and Schedule 3, that you can explain so far as you ensure the true and fair view. So our ultimate objective is to ensure that financial statements reflect true and fair view. They are not misleading. Okay. So therefore, accounting standards, you have an option. If you did not follow accounting standards, follow or explain. Follow or explain. You either follow the accounting standards or you explain why you did not follow. Sir, what I need to explain, sir? What I need to explain? So you need to explain deviation. Which standard deviated? Which standard is deviated? Okay, you have to explain which standard is deviated. Why you have deviated? Reason. Why you have deviated? That is the reason. I have to show the reason. Okay, reason why I have deviated. And what is the effect of deviation? What is the financial effect of deviation? What is the financial effect of deviation? What is the financial effect of deviation? So which standard is deviated, why you have deviated, what is the reason for that, and what is the financial effect of deviation? So when we deviate the accounting standard, either you follow the accounting standard or explain the deviation. So which standard you have deviated, why you have deviated, that is the reason behind deviation, and what is the financial effect of that. Okay, whether profit will increase or decrease because of the deviation, whether the current liabilities will increase or decrease because of the deviation. These are the examples. So what is the impact of profit, impact on profit and loss account and balance sheet because of deviation from the accounting standards? Okay, right. And Schedule 3 format. Finally, Schedule 3 format. And the Schedule 3 format is also not mandatory for regulated entities. 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 So what are the regulated entities? What are the regulated entities? So we have some regulated entities like insurance companies, banking companies, electricity companies, etc. Insurance, banking, and electricity. Insurance, banking, and electricity. Okay, so those are for them. Schedule 3 format is not mandatory because they have their own format. If you look at this, I'll show you here balance sheets. Okay, if you look at the balance sheet of Axis Bank, which is incorporated under Banking Regulation Act, their format is different. Capital, first they will write capital and liabilities, then assets. Employee stock option, reserves and surplus, deposits, borrowings, other liabilities and provisions. Cash and bank balances, RBI, balances with bank and money call, investment, advances, fixed assets, other assets, etc. This is not as per Schedule 3. This is not as per Schedule 3 because if you look at the Schedule 3 format for normal, for Ind AS companies, if you look at the Schedule 3 format for Ind AS companies, so this is what the Schedule 3 format for normal companies. For normal companies, this is what the Schedule 3 format. Okay, this I am showing for Ind AS companies. For accounting standards companies, reverse. First liabilities, then assets. So this Schedule 3 balance sheet I am showing for Ind AS companies because this accounting Axis Bank is also I am showing for Ind AS only. Okay, so therefore here assets, non-current assets, assets we have to write, then we have to write liabilities. Assets we have to write, then we have to write equity and liabilities. So therefore here what they have written, first they have written capital and liabilities, then they have written assets. And within the capital and liabilities also look at their heading: capital, employee stock option outstanding, reserves and surplus, deposits, borrowings, other liabilities and provisions. So this is capital, this is reserves and surplus, this is deposits, and this is borrowings, and this is other liabilities and provisions. This is other liabilities and provisions. Okay, right. So these are the 5 schedules. Whereas if you look at the other companies, equity share capital, other equity, financial liabilities, borrowings, lease liabilities, trade payables. So this format is completely different. Why? Because this is not Schedule 3 format. This is not Schedule 3 format because it is incorporated under Banking Regulation Act. For them, Schedule 3 format is not applicable. Similarly, if you look at the other companies also, insurance company, look at this. This is HDFC Life Insurance Company Limited. This is the balance sheet of HDFC Bank, HDFC Life Insurance. Since it is incorporated Insurance Act, look at this, they have different formats, shareholders funds. So they have two broad headings, shareholders funds and policy holders funds. Shareholders funds and policy holders funds. So policy liabilities, insurance reserves, provision for linked liabilities, fair value change, and application of funds, investment, shareholders investments, policy holders investments, cash and bank balances, like this. So therefore, this is not at all a Schedule 3 format. That's why. So therefore, Schedule 3 format is not mandatory for regulated entities like insurance, banking, electricity, etc. Okay, right. These are the essential requirements of financial statements. So what are the components of financial statements I have seen, and what are the essential requirements of financial statements? And the Schedule 3 format is not applicable for the regulated entities. Schedule 3 format is not applicable for regulated entities. Okay, so the important point is that certain information which is required to be disclosed certain information required to be disclosed as per the Companies Act, required to be disclosed as per Companies Act 2013. Certain information required to be disclosed as per Companies Act 2013, but not required to be disclosed as per regulation, but not required as per the regulated, as per the regulated act, as per the regulatory act. Sir, what is the regulatory act? Sir, insurance, banking, electricity. Insurance, banking, electricity. So as per the regulatory act. So therefore regulated entities will not disclose such information. Regulated entities will not disclose such information. Regulated entities will not disclose such information. Okay, we should still treat them as a true and fair view. We should still treat them as true and fair view. We should still treat them as a true and fair view. We should not treat as not disclosing true and fair view. We should still treat them as true and fair view, not reject. We should still treat them as a true and fair view. This is the very important point. Should not be treated as not disclosing true and fair view. This is the important point. Shall not be treated as not disclosing true and fair view. We have to treat them as a true and fair view only, even though they did not disclose certain information. Even though they did not disclose certain information which is required to be disclosed. Sir, why they did not disclose, sir? Because though it is required under the Companies Act, it is not required as per their own act. It is not required as per their own act. Therefore, they did not disclose it. Accordingly, we should not reject them. We have to treat them as disclosing the true and fair view only. We should not reject them. Okay. So this is the Schedule 3 format for regulated entities. Coming to the accounting standards, who frames the accounting standards? So coming to the accounting standards, who frames the accounting standard? Okay, accounting standards. So coming to the accounting standards, so accounting standards are drafted by the ICA or prepared by ICA. So accounting standards are prepared by ICA. Thereafter examined by NFRA. Examined or verified by NFRA, National Financial Reporting Authority. So NFRA makes recommendations to central government. NFRA makes recommendations to central government. Then central government will announce the accounting standards, will announce mandatory accounting standards. Central government will announce mandatory accounting standards. Thereafter, companies shall follow accounting standards. Companies shall follow accounting standards mandated by central government. Companies shall follow accounting standards mandated by central government. So this is the sequence relating to accounting standards. So first, accounting standards are prepared by the ICAI. Thereafter, they will be verified or studied by the NFRA. NFRA will study the accounting standards, and NFRA will make recommendations to central government. After analyzing the recommendations of NFRA, central government will announce that yes, these are the mandatory accounting standards you have to follow. Thereafter, companies will follow the mandatory accounting standards. Okay, so this is all about the accounting standards. Regulated entities and accounting standards, who prepared the accounting standards. Next, coming to the interim financial statements. So at present, listed companies are preparing financial statements quarterly. Okay, at present, frequency of financial statements. What we have to learn now is frequency of financial statements. Frequency of preparation of financial statements. Frequency of preparation of financial statements. Okay, if you want, you can take the screenshot of this above thing. Okay. Okay, anyway, if you want, you can take the screenshot of this. Accounting standards prepared by ICAI, verified by NFRA, studied by NFRA. They will make recommendations to central government. Thereafter, central government will announce. Thereafter, companies will follow. Okay, you can take the screenshot of it, or you can pause the video and you can note it down. This points. Next, so frequency of preparation of accounting standards, sorry, financial statements. Frequency of preparation of financial statements. Frequency of preparation of financial statements. At present, listed companies, at present, listed companies are doing it quarterly. At present, listed companies are doing quarterly. Unlisted companies, they are doing yearly. At present, listed companies are doing quarterly and unlisted companies are doing yearly. At present, listed companies are doing quarterly and unlisted companies are doing yearly. Okay, unlisted companies are doing quarterly and unlisted companies are doing yearly. That is at present. That is at present. So in future, proposal in future. In future, proposal in future. Future proposal. Okay, future proposal. So future proposal for unlisted company only. At present and future proposal. Future, there won't be much change for the listed companies. Future proposal, unlisted companies. Future proposal, unlisted companies. What they have to do? Periodically. So periodically, they have to prepare the financial statements. So what is that periodically? We don't know. Central government is yet to announce periodically. Is it quarterly or is it half yearly or per annum? Maybe quarterly or half yearly. Maybe quarterly or half yearly. We don't know. We have to wait for the central government announcement. Central government as of now says only periodically. We have to prepare the financial statements periodically, but they are yet to announce whether it is quarterly or half yearly. So therefore we have to wait and see. So now I'll give the table. Okay. So unlisted companies present and future. Okay. Unlisted companies present and future. I'll show you. Okay. First we have to write unlisted companies. Unlisted companies, frequency of financial statements, So I'll write various categories. So first one is preparation by management, thereafter approval by board of directors, thereafter verified by auditors, thereafter accepted by shareholders, filing with ROC. So unlisted companies, what is at present and what is the proposal in future? Present proposal. Okay, so at present what they are doing, all this they are doing yearly only. Okay, at present unlisted companies, they are doing everything yearly only. Okay, at present they are doing everything yearly only. Preparation by management, approval by board, verified by auditor, accepted by shareholder, filing with ROC. But what is the proposal is that preparation, this will be periodical. Preparation will be periodical. We don't know, maybe quarterly or half yearly. Okay, approval by board, this is also periodical. Quarterly or half yearly. And verification by auditor, this is also periodical, quarterly or half yearly. But the important thing is that acceptance by shareholders still yearly only. Acceptance by shareholders is still yearly only. This will never be periodical basis. AGM cannot be conducted quarterly or half yearly because the name itself says AGM, annual general meeting. That cannot be conducted periodically. That has to be conducted yearly only. So therefore remaining else, preparation, approval, verification, filing, everything you can do quarterly. But shareholders acceptance will come only yearly. This is also periodically. Quarterly or half yearly. This is what the point. Unlisted companies, frequency of financial statements. So at present, preparation by management, approval by board, verified by auditor, acceptance by shareholders, filing with ROC. This is a sequence. So first management will prepare the financial statements. Thereafter, the board of directors will approve the financial statements. Thereafter, auditor will verify the financial statements. Thereafter, shareholders will accept at the AGM. Thereafter, it is filed with the ROC. This is the sequence of financial statements. So at present, everything is going on yearly only. But proposal is that preparation, approval, audit, and filing is periodical, not adoption. Look at the provision. What the provision says: preparation periodical. So So you can prepare periodically, you can approve periodically, you can do audit periodically, you can file periodically, but not acceptance by shareholders. But not acceptance by shareholders. If you carefully observe the 129A, they're very clear. They only say preparation, approval, audit, and filing. They did not talk about the acceptance by shareholder because it is not possible. AGM is conducted only yearly once. Therefore, that continues to be yearly only. Shareholders acceptance continues to be yearly only. But remaining things they can go periodically. Okay, right? That is what is the interim financial statement section 129A. Next, coming to authentication of financial statements, who has to sign on the financial statements? Authentication of financial statements or signing of financial statements. Okay, authentication of financial statements, authentication or signing of financial statements, authentication or signing of financial statements. So who has to sign on the financial statements? Now we have to check whether company has appointed a chairperson. First column I need to check is whether company has appointed chairperson. Whether company has appointed chairperson. Okay, so I'll write this as first column. I'll put as a column here. Right. Okay, authentication of financial statements. So first, whether company has appointed a chairperson. Whether company has appointed a chairperson. Whether company has appointed chairperson. Whether company has appointed a chairperson. This is the first thing. Next, whether board has authorized such chairperson. Whether board has authorized such chairperson. Whether board has authorized such a chairperson. Whether board has authorized such chairperson. Whether company has managing director. Whether company has managing director. Next, at the end, who has to sign? Who has to sign on financial statements? Who has to sign on financial statements? Who has to sign on financial statements? So based on the scenario, who has to sign on the financial statements? Sir, whether company has appointed a chairperson? Yes. Sorry, first we'll write no. Whether company has appointed a chairperson? No. If company has not appointed a chairperson, there is no question of giving authorization or not giving authorization, not applicable. Whether company has appointed a managing director? No. Assume company did not appointed a managing director. Then who has to sign? Two directors has to sign. Any two directors can sign. Okay, any two directors can sign. Any two directors can sign. On the other hand, check whether company has appointed a chairperson. Whether company has appointed a chairperson? No. Whether obviously this is not applicable. Whether company has a managing director? Yes. The company has a managing director. Then who has to sign? Managing director plus one other director. Managing director plus one other director, they have to sign on the financial statements. Next, so whether company has a chairperson? Yes. Whether the board has authorized such chairperson? No. Whether company has a managing director? No. Then also any two directors, because even though company has a chairperson, but he is not authorized by board of directors. Therefore, same like any two directors. Any two directors. Okay, company has a chairperson, but board has not given authorization to them. Okay, whether company has a chairperson? Yes. Okay, whether chairperson has authorized? No. Whether company has a managing director? Yes. Then two managing directors, or then one managing director plus one other director. Both are same. 1, 2, 3, 4 are same. Just for your clarity, I'm giving. So if whether the chairperson has, if the company does not appoint a chairperson, okay, or if the company has appointed a chairperson, but board of directors has not given authorization to them, whether company has a chairperson, whether company has a chairperson, whether company has a chairperson? Yes. Whether board has authorized such chairperson? Yes. Whether company has a managing director? Not required, not necessary to analyze, not required to analyze, not required to analyze. Okay, whether it is yes or no. Whether company has a chairperson, whether the company has a managing director? No. Or whether company has a chairperson and board has authorized a chairperson and company has a managing director. In both the cases, who will sign? Chairperson will sign. Chairperson will sign. Here also chairperson will sign. So the moment when the company has a chairperson and such chairperson is authorized by the board, we need not worry about the managing director. So irrespective of that, chairperson only will sign. So this is the sequence. Who has to sign on the financial statements? First, check whether company has appointed a chairperson. No, sir, company has not appointed a chairperson. If company has not appointed a chairperson, there is no question of board giving authorization or not giving authorization to him. Therefore, not applicable. But we have to check the managing director. Whether company has a managing director? No. Any two directors. Though company does not have a chairperson, but company has a managing director. Managing director plus one other director. Though company has a managing director, but he has not been authorized by the board. He has not been authorized by the board. In that case, also same. Like having no chairperson or chairperson having but not authorized by the board, both are same. Whether our company is not having chairperson at all or our company is having chairperson, but board of directors has not approved the chairperson, even then the position is same. So if the company has a chairperson and the board also authorizes such chairperson, then we need not look at the managing director. So we have to straight away we have to take the chairperson. In all the cases, this is one thing. So apart from this, in all the cases, what we should do? Plus in addition to that, chief financial officer, company secretary, chief executive officer, company secretary. Okay, in addition to the above, in all the cases, in addition to the above, if appointed, wherever appointed, it's not that mandatorily these persons should be there in the company. If company has appointed a CFO will sign. If company has appointed a CEO will sign. If company has appointed a company secretary will sign. If they have not appointed, we will leave it. Just stick on to the above thing. Two directors, chairperson, managing director, just stick on to that. If at all the company has appointed any of these persons, CFOs, CEO or CS, then they have sign. Otherwise, we'll ignore it. Otherwise, we'll just stick on to the first entity. Okay. So this is all about the financial statements. So first thing we have to check what are the financial statements we prepared. I'll give a space so that you can take the screenshot. So first, what are the financial statements? Set of financial statements: balance sheet, profit and loss account, cash flow statement, and statement of changes in equity. Alternative to the profit and loss account, will take income and expenditure account. Cash flow statement not mandatory for Department of Studies, DOS, dormant company, OPC, and small company. Okay, right. Next. So based on that diagram, which companies has to prepare which financial statements? Companies following Ind AS, they have to prepare all the four. Dormant, 1% startup company, they have to prepare only balance sheet, profit and loss account, but not cash flow statement and changes in equity. Other companies, they have to prepare balance sheet, profit and loss account, and cash flow, but not statement of changes in equity. Essential requirements of financial statements: normally they have to reflect true and fair view, accounting standards, and JW3. Accounting standards, you have an option, either follow or explain. If you did not follow, you have to write which standard is deviated and why you have deviated, reason, and what is the financial effect of deviation. So Schedule 3 format is not applicable for regulated entities, insurance, banking, and electricity entities. So this is the very important true or false question. So certain information which is required to be disclosed as per Companies Act, but not required to be disclosed as per the Insurance, Banking, and Electricity Act. But not required to be disclosed as per the Insurance, Banking, and Electricity Act. So regulated entities will not disclose such information. Even then, we have to treat them as a true and fair view. Just because they did not disclose that information, we should not reject them as not disclosing true and fair view. Don't reject as not disclosing true and fair view. Don't reject as not disclosing true and fair view. Okay, right. Next, accounting standards, it will be prepared by the ICA. Thereafter, they will be studied by the NFRA. Thereafter, NFRA will give recommendations to central government. Central government will announce mandatory accounting standards, and companies shall follow accounting standards mandated by central government. Okay, right. Next, frequency of preparation of financial statements. At present, listed companies quarterly, unlisted companies yearly. Future proposal is that unlisted companies also, they should come out with periodically. What is the periodical? Nobody knows. It may be quarterly or it may be half yearly also. Okay, so this is the unlisted companies frequency of financial statements. What is the present thing and what is the proposal? So present, everything is yearly. Preparation, approval, verified, acceptance, filing, everything is yearly. In proposal, they may make acceptance as yearly. They may make acceptance by shareholders as yearly, remaining thing periodically, quarterly or half yearly. Authentication of financial statements based on whether company has a chairperson or not. If the company has a chairperson, whether board has authorized such chairperson or not, whether company has a managing director or not. So based on this, we have to determine who has to sign on the financial statements. Okay, so this all with the financial statements. Okay, in the next lecture, we'll discuss the consolidated financial statements. Okay, thank you.